What's up, guys? Welcome to another Market Radar podcast. Hope you've had a great week. The markets didn't do too bad, so I hope you survived. Let's take a look at the calendar for next week. We've got CPI. That's the big day. That's what everyone's looking for. You know, everyone keeps saying this is the most important CPI print of our lifetimes. It always seems to work out that way. We've got that on Tuesday. We've got jobless claims on Thursday. Those are the two main things we'll be looking for next week. Let's take a look at the ES performance over this past week. We did come off the highs across all indexes, but that was pretty expected based off of the massive rally we got right after FOMC. We're obviously expected to get a pullback. You know, think of it like RPMs on a car. You know, if you're going up, you're going to have to shift gears. The RPMs have to come down. That's a fairly normal price action, which is why we hedged for this. As you can see, NQ did pull back quite a bit more than the other indexes. So we did hedge for it. If you want to know how we did it, what our strategy is, take a look in the Discord. We post everything live there, and you can see what we used to hedge our current position. Now, moving on to bonds, let's take a look at ZB. This past week, we did see quite a large pullback. This was something that we expected. We did mention this over the last few weeks when we noticed that bonds were not able to break out despite data points coming out and most equity investors thinking that inflation has peaked. We did mention that it is not the peak in inflation. If it were, bonds would have been heading higher. And the only reason they didn't do that is because they saw what was coming. And just as we're seeing now, people are realizing that, oh shit, maybe inflation did not peak and it's coming back. So this is exactly why, we've been saying this since probably October, November, that chop is the most likely outcome in bonds. Bonds are still not the play. We need deflation for bonds to be the play. We're likely going to get chopped for the next 3 to 6 months at least. It's honestly looking like it could last quite a bit longer. Now that we're seeing the EFFR, the back end of the EFFR lifting up again. Let's take a look here. So this is December 2023 contracts on the federal funds futures. We're seeing it starting to break out now. We used to see a cut starting to be priced in. Here's the our Fed forecaster. We had a full cut priced in December. Now we don't. And essentially what this is telling us is a recession is getting pushed back. Everyone's been saying recession's coming, but it just keeps getting pushed back further and further. The can is being kicked further and further down the road. And mainly because inflation is remaining sticky. So we may get persistent stagflation in the later end of 2023. We'll have to see how it plays out. It's really dependent on growth. Inflation plus growth, we can get an equity rally as we've been seeing. But without that growth component, we're going to continue stagflation chop, but it still won't be the deflation that everyone's looking for where bonds become the long play. It's going to be more of what we've had throughout 2022, where maybe not this downward move in bonds. That would mean the Fed would have to continue hiking quite a bit. We probably won't be seeing that, but if they're holding rates where we are now, maybe they go up to 6%, it's going to be sideways action for a very long time if that happens, until something breaks, and that's what we're waiting for. But anyway, Gamma, you want to take us into the topic for today?
Okay, so today we're going to talk about the advisors, what they're doing, and how they're pretty much single-handedly screwing over the average investor. Now, that might sound weird, right? An advisor is screwing the investor because how are they screwing them if they're charging them a flat rate? You can see on a chart here, this is the total assets under management for investment advisors registered at the U.S. Securities and Exchange Commission from 2000 to 2021. Now, this likely includes family offices, hedge funds, and whatnot, but you can see that this has grown aggressively in just the last 10 years, right? So we were at 50 trillion, now we're at 100 and almost 30 trillion as of 2021, and this has likely gone even higher in the last year.
Well, why do you
So
think that is? Is it just people don't know what to do with their money, or what's causing that? Is their marketing getting better?
I think that there's a few things around it, right? So there's obviously the issue of more money floating around. That's one, but the other issues are going to be um, more money, right? Chasing, or I should say, more money honing in on the idea that the stock market is a guarantee, right?
Okay.
Let's just go back 10 years, right? The total assets under management here 10 years ago was 50 trillion. Now, the idea might have been, or it was, especially coming out of 2008, even into 2008, there's a lot of people that had money in the market, but the market wasn't seen as the all and money making machine, right? Like that it
Right.
is
Whereas
now.
whereas now it's just a casino.
It's a casino, right? And you only have so many advisors too, right? So you can also think of this as the inflationary term of um, lots of assets chasing few, like the few goods that there are, right? There's only X amount of advisors. Now, obviously, advisors can go up and down, but obviously, more. There's going to be a higher influx of money than there is of advisors, right? That's just how it is. So, what ends up happening is you have more people concentrating their investments across these advisors because the markets are obviously getting wilder as we go along. Even in a low volatility environment of this whole like Trump regime, right? When he was president, 16 to 20, that was still a wild time for markets, right? Literally, the stock market went up it seemed like almost every day. And
Right.
everyone was making money left and right. And even in that environment, the AUM still went up. So there is this demand for someone else to take care of your problems, which is what the investment. If you're an investment advisor outside of a hedge fund looking for specific returns, you're just a professional babysitter for money. It's what you are. You answer the phone, say, "Yeah, your account's looking great," or "No, your account's down. You need money. You want to deposit money. You want to talk about your investments. You have questions. I'm here to answer." That's what an advisor is doing. Unfortunately, we also live in this era of false advisors, and we're going to get into that in a second. But what you can see here by this is the average total percentage charged by brokerage company, and this is the total. You can see the total fee percentage here, and the brokerage company on the bottom. Now, what you can see is that the average percentage is between 1.98 and 1.06 across these firms. So you're looking at mid ones, right? Mid 1%, 1.5% a fee. Now, obviously, this can be derived from a lot of different things at these firms, but typically a managed money account is going to be between 1% and 2%. So this lines up with that ideology. The problem is how that 1% to 2% is actually being or what it's being charged for. And this is where the scam comes in that nobody really understands. And I know there might be some financial advisors that may listen to this show, to the podcast, and they may not like what I'm about to say, but it's the truth. So, Vanguard is the biggest investment advisory, or I should say, money management firm in the world. They hold like $4 trillion. Okay, Vanguard offers a service where they can outsource the investment advisory. I should say, the investment advice to other registered investment advisors. So think of it like this: Person A is an RIA, registered investment advisor. Okay, Vanguard, and you have the client. The person A approaches the client and says, "Listen, I can manage your money for 2% a year or 1.5% a year." Client A goes, excuse me, the client to Person A, the investor, the investment advisor goes, okay, sure. Here's my money chart. I understand your fees. The investment advisor turns to Vanguard and will say, okay, give me a list of your advisors. I'm going to pick the ones that I want my client to be invested in. Not investments, but investment advisors. So what your registered investment advisor is doing is not picking stock for you. He's picking people for you to manage your money. Okay. So the problem is the people that he's picking are going to charge him a fee. Let's just say he's charging you 1.5%. Maybe Vanguard all in is charging you 30 to 40 basis points. So he's only making 1.1. But he's really making 1.1 for connecting two people, and he doesn't have to do anything.
Right.
So
So
what?
it's like everyone's taking a little cut of your money.
Right. And the problem is this investment advisory space. And again, I know some people here are not going to like to hear this. It's seen as a retirement game on Wall Street. It is literally like public storage. You have a storage, each storage unit in a public storage facility is a client. And the more you can fit in each storage unit, the more returns you're going to get. The idea is stack as many clients as you can with assets, or I should really just say stack as much assets as you can, collect your fee, and go about your day. I know people that are making $750,000 a year, and they're on the golf course. They're going on vacations. They have a secretary that is answering phone calls. They'll come in. They'll do something. They'll handle clients. But it's not what you think it is. It's not this what you envision this guy doing or these people doing is not really what they're doing. Literally, they're not sitting there breaking down stocks for every single portfolio that they have. Think about it. Here's a great way to put this. Investment advisors love to tout how much they have under management. You know, 500 million, 250 million, a billion, right? Well, if you understand how those accounts are being derived, let's just say 100 million, and let's just say the average client, if they're lucky, if they're really just high net worth, is $1 million, let's just say, that's 100 clients, right? But 100 million small in the advisory game. You're talking 500 million. Just say you're still at one. Maybe you'll have a couple of 5 million guys, 10 million guys. Maybe you'll have a couple of 500, 250,000, 750,000, averages out maybe to $1 million, right? You got 500. So you have 500 clients. Do you really think your guy is sitting at his desk with a Red Bull and Adderall and going through every single account and making sure that your risk profile is set to what you desire to do? Because if you really look closely at those papers when you sign up for an advisory account, you'll realize that there's risk buckets. And there goes something like this. I mean, they vary from paperwork to paperwork or firm to firm, but to be like speculative, growth or maximum growth, conservative, and then like safety. And in reality, your advisor is only managing 5 portfolios. Speculative portfolio, and he's only focused on those. And furthermore, he's subletting that work out to other advisors. So he's really only watching where those portfolios are going up to that point where the advisors take control. And if the advisors aren't performing well, it's like, oh, I'm gonna have to fire him and swap him out. That's their decision making. It isn't let me load. If you think your advisor is really thinking deep and hard, and again, there are some that will, and there are some that do this, but this is a retirement game. This is the leg in Wall Street that you get when you're an old age. You can do this in old age because it requires no tedious work. Okay, so where I'm going with is if there's a macroeconomic event coming up, for example, you're and you're not gonna. It's not gonna make much sense until I explain to you what I'm talking about. But the reason those risk buckets are laid out in that manner are so the advisor doesn't get sued. It's all about protection. Because in reality, he doesn't really care about your returns. The two things that he cares about is the money he's making and his liability. And that liability is losing you money. So he doesn't want to lose you money and he wants to make money. So what he's going to do is he's going to protect himself first, obviously, because it's the liability part. If he is marked out of the business or he can no longer work in the space, he won't be able to make money. So his number one priority is protecting himself. And then it's going to be to make you money, to keep you happy so he can continue to making money off of you. The problem is that with those risk buckets, he can only do so much for you. And if he wants, usually in most setups for RIAs, what can happen is you can go lower on the risk spectrum, but you can't go higher. Meaning, if you're spec, the most aggressive, you can go backwards, and you won't really run into an issue. It's when you have something coded for maximum growth and you push forward and you go to speculative, or you have something coded for conservative, right? And you go all the way to speculative. Then people are like, oh my God, this person wasn't suitable. And then you run into regulatory issues. And this is a common thing you see happening all the time in the advisor space. If you have friends there, people, I get told this all the time. And what ends up happening is that these advisors are almost scared to go to cash for two reasons. Number one, for example, if we're talking about a macro event that you think, let's dumb this down. You think the market's going to crash. What are you going to do in your advisory account? Because you can't concentrate positions either. You can't allocate someone into one thing, because that's deemed as, especially someone that's not on the speculative, nowhere near the speculative side. You can't buy one thing, and you also can't go all in cash either, because what happens? Most of these advisor agreements have a disclosure that if the money's in cash, they're not making money on it. So if that person's got $1 million and $10,000 is invested, they're only getting 1% or 1.5% of $10,000. So there's no incentive for them to keep cash on the table.
Right. Well, so what's the alternative for people? If someone really just doesn't have the time, and quite frankly, most people are just stupid with money. They don't know anything about finance. Isn't this still like the best route that they can go to, or what?
No, not necessarily, because at the end of the day, the advisor's taking 1.5% a year, right? Whatever it is. And you as an investor. So I guess the best way to simplify this, to answer your question, right, and really hone this back home, the advisor is just trying to keep up with the benchmark. As long as he's at the benchmark or around the benchmark, he's doing you a good job. And you're paying for that. So why not just buy the benchmark?
Right. Yeah, and then you don't even have to pay a fee. Well, I mean, you got if you're holding the S&P, you'll have to pay an expense ratio, but that's peanuts compared to
what they're charging
fees.
Right. And you can buy the S&P 500 and just try. And look, this is obviously not advice for those that are using an investment advisor that may find use in investment advisors. They're not all bad. They're not bad in general. The point I'm trying to get home here is, if you're using an investment advisor and you're not tracking the benchmark, why are you using the investment advisor? And for the investment advisors that are still listening this far through, why are you outsourcing the work to all these sub-advisors that may or may not get the returns right, and you can no longer defend those people? Where I'm going with that is as follows. Because you pick an advisor or sublet those assets out, and that advisor performs poorly, it's no longer your investment decision. Now, you may say, oh, that person's way more qualified to make those decisions. Sure, you can jolly around all you want. A lot of people got smoked in this last crash in the 2022 market crash, long FANG stocks, for the main reason that they believed that if they stay long FANG long enough, it'll track the market. And it did that exactly to the downside. Now, as an advisor client, as a client of an advisor, what do you do in that situation? Like, if you're the client, put yourself in the client's shoes. If you're an advisor, right? Put yourself in the client's shoes. They just saw these names get sawed in half, and they're not mad at you. Most likely, they're really not. they're probably looking around and they're like, oh, the market's down. Oh, okay, makes sense. But you charge them a fee for what? You you didn't even get the downside move right. It's not like they paid you a fee to really stop them from losing any more money than they had to lose. Now, if you're an advisor that took the clients out and moved them to cash products, it really tried to maximize the defense protocol going into this, then kudos to you. Yeah, you listen, you're 1.5%. That's you know, I understand. But this all stems back from this hedge fund industry, right? Where they're charging 2 and 20s. Obviously, advisor is not getting the 20% performance fee, but a hedge fund's charging a 2% fee. The reason a hedge fund is charging a 2% fee is they're looking to maintain business operations in volatile markets. Here's an example. Let's just say the market goes sideways, right? And your performance is lackluster for a year, right? And you don't get your carried interest, your performance fee. Well, you still need to obviously operate the fund, pay out expenses, fund management, etc. You need that management fee, okay, to operate the fund, and the performance fee is gravy. Now, there are some funds out there that drop the management fee completely and just really charge a higher and more aggressive performance fee. And there are just funds that really are just charging aggressive performance fees, like Jim Simon's in the Medallion Fund, but obviously that's closed to public now. But that was, I think, at some points was like a 40%, 40%, 40% carry. Now, regardless, these people are running an operation. Okay, they're 2% management fee. What when you're talking about an investment advisor, they are not running an operation. If you really think about it, their management fees, the management fee, to simplify this, the management fees are not paid in the idea of exorbitant returns. When you pay a 2% management fee to a hedge fund, you're in it to win it, right? Like we're looking for 25, 30% plus return. We're looking to really blow the market out of the water. You're paying that management fee to a hedge fund manager because you understand that there's management costs, and the idea is that he is trying to, will do, or at least meet the performance of the market. But meanwhile, when you go to a money manager, you're paying them 1.5%, but now you're just looking to track the benchmark.
Right. So there really doesn't feel like there's a valid reason to ever do that.
Right. And I never understood that. I never understood where these money managers were coming from, especially those that treat this as the retire game. Now, if you're a money manager, there's nothing wrong with your 1-2% fees. I understand the financial business, there's fees everywhere. And it's one of the most grossly overcompensated spaces in the world is the finance business. And that's why, that's what attracts people to it. Like everyone wants to make money, but you have to understand what you're providing to your clients. If your clients are making money and they're outperforming the benchmark, even just marginally, right? Maybe 50 basis points after your fees every year. And when the market falls, they're doing 50 basis points better. You're providing that is a value for 2%. That makes sense. But if you're not even tracking the benchmark and you're not doing well to the point where the client is actually getting ahead over the benchmark with your fees calculated in or wrapped in, then ask yourself, what value are you really providing? Instead, you're preventing the client from actually making returns. You're preventing the client from capturing what the market is giving freely in an index fund. So if we take the S&P 500 total SPY ETF total return with dividends and take the expense fee out and all in value total return, and you compare that to what you're doing with your models, along with what you're or with your funds as an advisor, or your advisor is doing with your funds, right? You run the side by side, and you see that over a term of 5, 10 years, 3 years, however far you want to look, that you're really not ahead, or you're just on the line, and it's not enough for it to be that much of a difference, then why are you putting your money in that place? That's the real question. You should ask yourself, you should say, okay, is this advisor really providing a benefit to my portfolio? And this is just basic due diligence. You know, you don't even forget what the advisor is, forget what he's doing, forget his qualifications. With his returns that I'm experiencing, or I can see if he's going to share them, are these returns that much better than the benchmark that it makes sense to be in this fund now, or under this manager? A simple way to say it: have a benchmark and have a 60-40. You can shit on the 60-40 all you want, but it's something anybody can do that. Literally, 60% here,
Literally
40%
no
here.
effort.
I'll balance it monthly. Once a month, you got to log into your E-Trade and not, obviously there's no quick balance. I'm sure they have robo advisors that will just balance it for you, but you can literally go on there and just do the math on the spot with a spreadsheet or on a notepad and say, okay, 60% of my account value here, 40% here, rebalance it, done once a month, right? Go look at 60-40 historical returns, look at the average return of the S&P 500, and look at the average return of your advisor. If he's not beating the 60-40 and the benchmark returns, what are you doing? That's really what you should do. And like, obviously, we come from a standpoint that the way we manage we manage our money, and we do this publicly, is through Aries, our portfolio model, which is leveraged. Okay, so it's not for everybody. It's not for anybody, really. It's our model. It's what we do. We just show you what we're doing. We don't expect you to use this or act on it in any actual capacity. It's more of just an indication of what we're doing. Anyways, that is the structure that we lay out our investment thesis behind. Minimize drawdowns to a degree, capture returns, get comfortable with it, leverage it, understand it, and as long as those drawdowns aren't wiping you out and you can manage that with your own capital and with your own allocation, it fits your role. Now, leveraged funds have higher expense fees. That's normal. But again, go back to what I just said. I am willing to put my money into me personally, this is my personal opinion. I'm willing to put my money into a leveraged fund, even with a 1% expense ratio, 2% expense ratio, whatever the expense ratio is, right? Because I know exactly what I'm getting. For 2%, I'm getting 3x the daily moves on whatever the index is, right? Or for I think the SPY expense ratio is like 15 basis points, I think, off the top of my head.
Yeah, it's pretty much negligible.
Right. For that 15 basis points I'm losing, I know I'm tracking the S&P 500. You see what I'm saying? But for the 1.5 for the 2% you give to a hedge fund manager, I don't know I'm going to beat returns, but I know that guy is going to do everything he can to blow returns out of the water, right?
Right.
But for 1.5%, I'm just trying to keep up with the market. And unfortunately, a lot of people that invest in these advisors, they don't do the due diligence and this is the sad part, is they're looking for someone just to talk to about their investment. They want someone they can call up and they can say, why is my account down? Will my account go up soon? Boom, 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 boom. As long as they get those answers, they can track the benchmark. They really won't care because with E-Trade, there's no calling anybody. It's you by yourself. To sum it up, obviously people want to use an advisor because it's someone they can talk to. It's someone that they can in the end take liability off of their own actions. It's always easier to look at the market being down and pointing your finger at someone else, at maybe being a hedge fund manager, advisor, instead of saying, I fucked up. In reality, you're down, your advisor made a mistake at somewhere along the lines. If you're down way below or way more than the indices are, but it's still your fault. You picked the advisor, but it feels better to point your finger at someone else and say, okay, he did a bad job, he'll fix it. Instead of I did a bad job, I have to fix it. And the issue that a lot of people run into is accountability. At the end of the day, wherever you send your money off to, it's your money. So you should be accountable or feel accountable for every dollar that's made or lost. And if you do, you will start realizing that poor performance, specifically well under trend or well under what the S&P is returning, is unacceptable. Because if you can't beat the S&P, that's our motto as well. If we can't beat the S&P, we just buy it. It's really not that complicated. This should not be such a hard thing to do. If you can't beat the returns of the benchmark, you belong the benchmark. And that's Warren Buffett's biggest gripe with all these well, those hedge fund managers over time is they won't consistently, most of them won't consistently outperform the market. So why not just long the market? And I think that's where we're going to wrap it up today. Thank you guys so much for listening, and we'll catch you on the next one.